Swayam Prabha. Digital India. Educated India.
Yoga Karmasu Kaushalam.
Friends, Namaskar. My name is Dr. S.C. Sardar, retired professor, SD School of Commerce, Gujarat University, Ahmedabad. Friends, at present we are discussing about preparation of final accounts. In continuation of it, we will see part 4. In previous part 3 of final accounts, we had discussion on meaning of adjustment and their role in final accounts. It is mandatory to rectify transactions which are not recorded or wrongly recorded to arrive at true and fair view of final accounts. Meaning of true and fair view: factual information without any manipulation should be disclosed. Types of adjustment: we have seen two types of adjustments, implicit adjustment and explicit adjustment and their explanation. Components of final accounts affected by adjustments: only trading account is affected. Trading and profit and loss account both are affected. Trading account and balance sheet are affected. Only P&L account is affected. P&L account and balance sheet are affected. Only balance sheet is affected. Trading account, P&L account and balance sheet are affected. Different types of adjustment, and out of this we have acquired detailed information for closing stock and outstanding expenses. Now we will discuss all the remaining adjustment in this part 4, preparation of final accounts. After having discussion on closing stock and outstanding expenses, we will discuss about prepaid or unexpired expenses, accrued or outstanding income, income received in advance or unearned income, depreciation, bad debts, provision for doubtful debts, provision for discount on debtors, manager's commission, interest on capital, goods distributed among staff members for staff welfare, drawings of goods for personal use, and last one is abnormal or accidental losses. Let us commence with prepaid or unexpired expenses or expenses paid in advance. Sometimes revenue expenses of next year are paid in current year. This payment is made in current year of next year as advance payment of expenses. Common examples of such expenses are prepaid rent, prepaid insurance and interest paid in advance, etc. If prepaid amount is included in the expense of current year, to that extent prepaid expenses to be reduced and is transferred to balance sheet at asset side and disclosed as prepaid expense. Accounting effect would remain similar for all kinds of prepaid revenue expenses. Let us understand this with one example. Example: an owner has paid annual shop rent Rs 60,000 with CGST and SGST at 6% each for the period commencing on 1st July 2024 and ending on 30th June 2025. Accounting year would be ending on 31st March 2025 and rent is paid for the year ending on 30th June 2025. See friends, in the tabular form information is provided to you. Commencement of accounting year is 1/4/2024. Yearly rent paid, that is from 1/6/2024 and ending on accounting year, that is 31st March 2025, and rent is paid expiring on 30th June 2025. Therefore, we have to make the two parts of this 60,000. The first 9 months which are completing on 30th March, that is 9 months, and after 31st March up to 30th June, 9 months and 3 months. Therefore, distribution of 60,000 is in the ratio of 3:1. Rupees 45,000 rent expenses of current year and rupees 15,000 is prepaid expense of rent. Now, we have to pass adjustment entry for that. So, adjusting entry is rent account debited rupees 60,000, input CGST debited rupees 3600, input SGST account debited rupees 3600 and to bank account 67,200 rupees. Now friends, entry for prepaid rent. Prepaid rent account debited by 15,000 and to rent account 15,000 rupees. Proportionately rupees 50,000 shall be deducted from rent because it is expense of next year. Important note, it should be noted that when amount is transferred from expense account to prepaid expense account, GST paid is not transferred, that is only the amount of expense is transferred to prepaid expense account. In our case, only rupees 15,000 are transferred. Now friends, we will see the disclosure of this item in our final accounts. As I told, in the profit and loss account, we will show the rent of 60,000 rupees, but this 60,000 rupees is not the expense of current year. It is including the expense of the next year also. Therefore, the whatever amount we have paid in advance, that is to be deducted to arrive at the net amount of current year. So 15,000 is our advance payment. So 15,000 will be deducted and we will have 45,000 as an expense of current year. Second effect will be given in the balance sheet. Still, since it is our prepaid rent, therefore 15,000 should be shown at the asset side. Now friends, we will go for the fourth item, accrued or outstanding income. See friends, Mr. Ramaswamy is owner of 10 flats. One flat is let out to Mr. and Mrs. Rana, but rent of 12,000 for the month of March 2025 is not paid by them. Accounting year is closed on 31st March 2025. Now rupees 12,000 is accrued or outstanding income for Mr. Ramaswamy. Accrued income are those incomes which have been earned during the accounting period but have not been received till the end of accounting period. Such incomes are known as outstanding incomes or incomes earned but not yet received. Common examples of such incomes are commission receivable, rent due but not received, etc. In all such cases, accounting treatment would remain same. Let us understand it with the example. Interest is receivable for the month of March 2025 of rupees 50,000. It is subject to levy of CGST and SGST at the rate of 6% each. The adjusting entry passed will be accrued interest account debit 56,000, to interest account 50,000, to output CGST account 3,000, to output SGST account 3,000 rupees. Now friends, see here, it is an income of current year and will be credited to profit and loss account. So here, when you are going to disclose in our final accounts, in our profit and loss account, it is interest of 56,000 to be shown at the credit side. And second effect to be given in the balance sheet, as on 31st March 2025, output CGST account will be shown at liability side. Output SGST account will be shown liability side 3,000 rupees because both are we have received from our customer. So it is our liability, and accrued interest is 56,000 rupees. Now, sixth adjustment is about income received in advance or unearned income. Friends, Mr. Ramaswamy is owner of 10 flats. One flat is let out to Mr. and Mrs. Rana, but rent of rupees 12,000 for the month of April 2025 is paid by them in advance. Accounting year is closed on 31st March 2025. Now 12,000 is income received in advance or unearned income for Mr. Ramaswamy. During accounting period, business may receive some part of income pertaining to the next year. That is called income received in advance or unearned income. Since it is not income of current year, it is to be eliminated from income of current year. If included, its separate adjustment entry is required. Friends, for example, commission for the month of April 2025 is received in March 2025 rupees 13,000. Total commission is received in cash in 2024-25 rupees 60,000. Applicable GST is 18%. Assume it is intrastate transaction. 13,000 is an income of the next year which will be ending on 31st March 2026, that is 2025-26, but is received in the current year 2024-25. It is unearned income of income received in advance. The general adjustment entry at the time of receiving income, here we have commission income, is to be passed. Solution: It is intrastate transaction, 9% CGST and 9% SGST shall be applied. Rupees 49,000 received in 2025, which includes rupees 13,000 for 2025-26. Let us understand its adjustment entry and disclose in final account. In our case, here bank account will be debited by 72,600, to commission account 60,000, to output CGST account 6,300, to output SGST account 6,300. It is total commission income received in current year. This includes rupees 13,000 of next year. Note, dear student, please note that in any question, if GST related information is not provided in such a case, same adjustment entry will be passed and effect pertaining to GST will be ignored. Now, in our case, income received in advance shall be cancelled from total commission income received in current year. So, here commission account will be debited by 13,000 rupees and commission received in advance will be credited by 13,000 rupees. Here rupees 13,000 shall be deducted from total income of rupees 60,000 and shall be disclosed in balance sheet at liability side. Disclosure in final accounts. Profit and loss account ended on 31st March 2025. Our commission income is of 60,000, but it is inclusive of income of next year 13,000 rupees. So, it will be deducted and we will have the income of current year 47,000 rupees. But this commission we have received in advance, it is our liability, therefore, it will be disclosed at the liability side 13,000 rupees. It is our income, we have collected GST on it. So, output CGST 6,300 and output SGST account also will be shown at the liability side. Now, friends, seventh adjustment we will discuss today, that is about depreciation. Depreciation is non-cash revenue expense. The depreciation is that amount by which the value of respective fixed tangible assets is reduced. This depreciation is debited to profit and loss account. The use of fixed asset is for revenue generation. Thus, expense of depreciation is debited to profit and loss account. Practically, the amount of fixed assets is distributed in number of years. This number of years is estimated life of respective assets. Generally, this life is determined by the manufacturer of the assets. There are different methods of depreciation. Straight line method, that is called SLM, written down value method called as WDV or reducing balance method, and others. Methods of recording depreciation in the books of accounts. This is very important, friend. Be careful for this because there are different methods given, but ultimately the effect of depreciation will remain identical in any method. Depreciation is recorded in the books of accounts either by crediting depreciation to the assets account or by crediting depreciation to provision for depreciation account. When the amount of depreciation is credited to the assets account, the value of assets reduced each year in the books of accounts by the amount of depreciation. On the other hand, when the amount of depreciation is credited to provision for depreciation account, the asset is shown in the books of accounts at its original cost. There are two situations of recording of depreciation. See, in the graph, in the picture, you can see that the depreciation recording situation, number 1 is depreciation is not recorded in the trial balance and number 2 is depreciation recorded in the trial balance. But when depreciation is not recorded in the trial balance, we have to see two other things: when depreciation is credited to assets account and when depreciation provision account is maintained. When depreciation is not recorded in trial balance, this situation has two options. A, by crediting depreciation to the assets account when provision account is not maintained, or B, by crediting depreciation to provision for depreciation account when depreciation provision account is maintained. Number 2 is when depreciation is recorded in trial balance. Let us understand these recording methods through example. One example is given to us. In trial balance of Mr. Dilip for the year ended 31st March 2005, debit balance of machinery is given to us of rupees 5,25,000. In adjustment, the estimated life of machinery is 10 years. After 10 years, realizable value is rupees 25,000. This example we will study with the assumption that the depreciation is not recorded in the trial balance. Let us see the solution. First of all, we have to compute annual depreciation. For computation of annual depreciation, a specific formula is used, and that formula is annual depreciation is equal to total cost of assets less estimated scrap value divided by estimated life. In our case, when we are determining the annual depreciation, our cost price is rupees 5,25,000, but at the end of the estimated life, we will realize 25,000 rupees. So, that 25,000 is to be deducted, and estimated life is 10 years. Therefore, annual depreciation which we will calculate is of rupees 50,000. The scrap value is deducted from cost price because on completion of the life of an asset, this amount will be received back by the owner. Thus, scrap value amount is not considered as a part of depreciation expense. Adjustment entry and disclosure in accounts. By crediting depreciation to the assets account when provision account is not maintained. When depreciation is given as an adjustment, the amount of depreciation is calculated at the rate and as per the method specified, and thereafter it is debited to profit and loss account. The amount of depreciation is deducted from the assets account in the balance sheet on which the depreciation is charged. Let us have a look on this. The amount of depreciation is deducted from the assets account in the balance sheet on which the depreciation is charged. Let us have a look on journal entry. When you are charging the depreciation machinery, the depreciation account is debited by 50,000 rupees and machinery account is credited by 50,000. When we are charging this depreciation 50,000, the value of machinery would reduce by this amount in the balance sheet. Now friends, the second entry is that is about closing entry. Depreciation is our expense and it is to be transferred to profit and loss account. So P&L account will be debited and depreciation account will be credited. So ultimately what will happen? Initial stage we have debited depreciation and in the closing entry we are crediting depreciation account. So depreciation account will be closed and transferred to profit and loss account. Let us have a look on disclosure in our final accounts. As I told you, the depreciation is our non-cash expenditure, it is our revenue expenditure, therefore, it would appear at the debit side of profit and loss account as a depreciation expense, and we have disclosed here over here rupees 50,000. And second effect will be given in the balance sheet. We are having machinery of rupees 5,25,000 and from that we will deduct depreciation of rupees 50,000 and finally we will have the value of our machinery 4,75,000. After 1 year, book value of machinery will be rupees 4,75,000 and every year rupees 50,000 will be deducted. At the end of the 10th year, balance will be rupees 25,000 and that is for scrap value. By crediting depreciation to provision for depreciation account when depreciation provision account is maintained. In this case, friend, have a look. Having calculated the amount of depreciation as per the given rate and as per the method specified in the equation, it is debited to profit and loss account. Amount of depreciation is added or credited to provision for depreciation account and total accumulated depreciation is shown as a liability side as a depreciation provision. In our case, depreciation account rupees 50,000 will be debited and we have debited over here, and here this amount will be credited to depreciation provision account. So what happened over here? The whatever depreciation we have charged 50,000 rupees, to that extent depreciation provision account is created in our books. Now friends, the whatever depreciation we have debited over here is to be credited and to be transferred to profit and loss account. So P&L account is debited by 50,000 rupees to depreciation account 50,000 rupees. Depreciation account will be closed and P&L account debited for depreciation expense. Now friends, have a look in disclosure in our final accounts. The same effect would appear over here in our profit and loss account debit side to depreciation account. But in balance sheet, it is very differently mentioned. Let us have a look on balance sheet. In balance sheet, you see the value of machinery is 5,25,000 and depreciation provision is given on the liability side 50,000 rupees. So, difference of asset side and liability side is of rupees 4,75,000. So, as I told you, whichever method you are applying, the final answer would remain same. Whether depreciation provision account is created or not, in both the cases net effect of depreciation would remain same, and that is rupees 4,75,000. When depreciation is recorded in trial balance. Friend, this is another important point. When depreciation is recorded in trial balance, at that time simply depreciation will be shown in profit and loss account debit side. Let us study another issue of depreciation, and that is time period. The amount of depreciation is charged on the basis of time period. The time period for which assets is used, to that extent depreciation is charged. Friends, let us see one example on it. A business owner has brought furniture in business on 172024 for rupees 1 lakh and rate of depreciation is 10%. Accounting period is April 2024 to March 2025, that is 1/4/2024 to 31st March 2025. Here furniture is introduced on 1/7/2024 and accounting period is ended on 31st March 2025. So, depreciation will be charged for 9 months only, from 1/7/2024 to 31st March 2025. Amount of depreciation is equal to 1 lakh at the rate of 10% for 9 months, that comes to rupees 7,500 to be charged as depreciation. In brief, during computation of depreciation, kindly ascertain the period for which assets is used. Friends, let us see summary pertaining to adjustment which we have discussed so far. The first we have seen adjustment about closing stock, then outstanding expenses, then prepaid or unexpaid expenses, accrued or outstanding income, income received in advance or unearned income, depreciation. Friends, all these adjustment we have studied with their adjustment entry, their impact on different components of the final accounts and their disclosure in final accounts. In next part 5, we will be continuing with other remaining adjustment with relevant examples and illustration. Thanks for listening.